Let's pray. Heavenly Father, we thank you for today. We gather together in the name of Jesus. We always been here waiting on you, believing and trusting that wisdom is imparted to us as business leaders. That kind of business insight and wisdom that brings us out of the doldrums and makes us mighty powerhouse, economic powerhouse that you called us to be. We thank you that even today as we hearing and seeing and listening, we receive more wisdom, inspiration, and receive counsel to be able to excel in our work in the name of Jesus. Amen.
Amen. Thank you for that prayer. So without much ado, I'd like to invite our very own investor, the senior financial expert, the tax expert who actually spoke to us on Tuesday, Mr. Michael Ssebaggala. We invite you and thank you for committing your time to speak to us. Over to you, Michael.
Thank you. Thank you, Mr. Jonan, and thank you everyone on the call. I hope everyone is well, and I hope everyone had a good night's sleep. So this is to further continue our discussion, continuing on from Tuesday, our session about tax. I hope everyone can see me and can hear me, so let me share my screen such that we can get this underway.
Do you have the right to share the screen?
Yes, I have the right.
Fantastic.
Yep, you can help me confirm whether you can see my screen, because here it's showing me that you can see my screen.
Yes, we can see.
Okay, thank you so much. So today I want to talk about a pertinent issue. That's a particular type of tax called value-added tax, which is VAT, for our discussion today. And this is a tax that is really prevalent, but it's one of those tax types that are a little bit, for lack of a better word, confusing to a normal business person. And since it's every day, the URA is very keen on this type of tax. So you will normally see that as you run your business, as and when you run your business, when you, of course, start becoming successful, like we discussed last time, this is one of the tax types that will be required by law, and the URA will constantly follow you up on it. So our idea is to understand really how a business collects VAT instead of paying this tax. So the basic understanding of VAT is that it's an indirect tax. So on whatever good or service that you buy, as long as that good is not exempt, you're paying VAT as the final consumer, whether you know it or not. This is the reasoning behind this. So the precursor to this type of tax was the head tax and head tax, whereby my grandparents tell me that in those days, every person that was above 18, I think, had to pay tax whenever and when they could come in, like in town, say. So they used to call it a type of tax, head tax. So every person had to pay tax, and you had to pay that money physically. So governments and entities around the world decided that this is not proper. Rather, let's add this type of tax to any good and service that is not zero rated or exempt. Then people will be comfortable paying it. So you don't have to hide, you don't have to run away, you don't have to keep hiding from the law and everything to pay this type of tax. So that's what gave birth to the normal VAT that you're seeing up until this present day. So our example here is to give you the basic understanding of what VAT is. And like I said, all this information is available on our website. That's PricewaterhouseCoopers. You can just type in PwC Uganda and you'll see all this simplified understanding of tax. So if an example is this: if you're selling your product, if your product is 1 million shillings, that's the product price or service price that you're offering. So VAT as a tax comes in and implies that you're going to charge 18% of that price. So that's why you're seeing that we have 18% times 1 million. So which will give us the VAT tax alone being 180,000. So the 1 million has to be added onto the 180,000 to get the total. Normally we call it the VAT inclusive amount. So that will give you the total value of that product or service that you're selling. And that is very, very key. So it's an additive tax on the product or service that you're selling. So that's one way to really, really understand the basics of this type of tax called VAT. Secondly, the portion now we come to what you have to do in order to understand the type of tax that you're going to pay to the URA. So given that it's a free market, there is buying. As a business, you buy, which are purchases, and as a business, you sell. Those are the sales or revenue or turnover, whatever you may want to call it. So that double whammy sorts has to be accounted for when we are applying VAT. My example is this, that the URA, even the return will show you that we have a section called output VAT. That's VAT on sales or VAT on all revenues for that month. Then you have a section that has input VAT, which is VAT for the purchases that you made as a business in the month. So the difference between the two is the VAT that has to be remitted to the URA. Let's using a similar example that we have just discussed earlier. If our sale is 1 million and we have charged VAT of 18%, which is 180,000, that means that that's output. So that is output. You're charging it to the final customer. It can be another business. It can be a normal consumer that has no business whatsoever. But for you, as the business that is making the sale, that is an output for you. So that's step one. Step two, we come to input. That is the purchases. So because for every product that you make or sell, you must have bought something. Even if you're in the business of selling services alone, there are certain purchases that you have to make. So there are certain things you have to buy. It can be computers, it can be, we can use any example. As long as it's a purchase that is made within the month, there is ideally VAT, unless it is zero or exempt, as we have seen in the earlier slide. So if our purchases are 500,000 for the month, that means that we have paid VAT, 500,000 times 18%, we have paid VAT on those purchases that we have made of 90,000. So that's what now we're calling input VAT. And this is going to be subtracted from the output VAT of 180,000. Because remember, the output VAT is not paid by you, it's paid by your customer. Then the input is paid by you. So you have to offset the two to get the net VAT that is paid. That's why we call it an indirect tax, and the business does not pay it. So it's simply, you're simply facilitating the flow of VAT from the source. So for a product like, say, cooking oil that is manufactured from a factory, all the people that are being sold to, who are buying and selling, the VAT has to be paid by the end consumer. So it's a charge to the final consumer that is making the purchase. So that would be the VAT that your business has to file and therefore pay. So if I take you to the simple understanding of registration for the VAT, because within the VAT Act, there are certain rules or laws that a business has to start registering for VAT in that matter. So if your business has a revenue of of 150 million per year, then automatically you qualify to register for VAT. 150 million is about 12.5 million per month. So with most of us, at least on the call, we know that we want to make billions of revenue. So once you cross that threshold, you have to understand that the law requires you, this is engraved in the law requires you to register for VAT. So registering is not very hard, it's easy, but once you register, there's certain requirements that you must meet. And this doesn't mean that because the law is very specific, this 150 million is broken down into 4 quarters. So if you meet that revenue threshold in 3 months period, that's 150 million divided by 4, 37.5 million. So if you make 37.5 million in revenue in 1 quarter, you must register for tax, the tax type called VAT. And if you don't, then, and the URA finds you out, which they will when you become successful, then it will be a whole different story. So let's talk about the several requirements that you have to fulfill once you register for VAT. So as a business that is registered for VAT, you must charge VAT whenever you make supplies that are VATable. So VATable, don't get intrigued by this word VATable. So VATable just means that all supplies to which you have to charge VAT. So whenever you're making supplies, so you're either selling, you have to charge VAT, or you're buying from the person that you're buying from, you must account for that VAT. So like we explained, it's an in and out. So you simply offsetting what you paid to your suppliers and VAT and what your customers are paying you. That difference is what you remit to the URA. Secondly, VAT is an ongoing tax. So every month when you make sales, you have to have your sales in a proper system and then file a return before the 15th day of the following month. So given that today is February 9, so the return for January 2023 has to be filed before 15th February. So that is also in the law. You have to follow that. And when you file, you have to pay. It's the same deadline, 15. So you have about 15 days from when you close the month up until the next, that deadline, the 15th of the following month, to make the filing, that is the return, and as well as make the payment. Then thirdly, as a business, only claim that input that we talked about from the purchases side. Only make a claim for the tax credits on expenses supported by e-invoices or IFRS. So there is no way we can talk about VAT without highlighting the fact that there is IFRS. So IFRS is this e-system, e-portal, whatever you can call it, that the URA uses to monitor these businesses that are registered for VAT. So all the purchases that we talked about must pass through this IFRS. So it's a whole discussion on its own, but just take it that the URA wants to see your invoices that are electronic in nature and have that stamp from the URA. So these ones are electronic in nature. And what happens is that whenever you buy from your supplier, they have to give you an IFRS invoice. So this is an invoice. Of course, all businesses have their systems that they use to monitor their books, but this is an invoice that has been passed through URA's interface, which is the IFRS. So once they give you that IFRS invoice, then you're allowed to offset it from any, because it shows that you paid VAT on your supplies, on your purchases. So that means that you can offset that with the output VAT that your customers are paying for you. So there is no way that the VAT return can actually file without you having these IFRS supported invoices. And I know last year there is a regulation that came out, it's in the public domain. The URA passed a regulation, it's in the law, that certain businesses that meet certain, because we started with a threshold of 150 million in revenue for the entire year, have to have VAT registration. But now there is another law on top of that, that certain businesses that of course have already exceeded the other 150 million threshold must register for IFRS and use, so their systems that they use for monitoring sales have to be like directly linked to the IFRS system. I remember on the call sometime, I think someone was asking how to integrate IFRS to QuickBooks. So that's the integration we're talking about. You must, for certain businesses, you must have that e-invoicing linked to your system. And I think it's about 1 billion. If you're making 1 billion revenue every month and above, then you're required to do that. The fourth thing that you have to do as a business, you have to apply for input tax credits within 6 months from the date of the invoice. So VAT is a very tricky tax type, like I said. So because as we know, there is credit, like when you buy purchases on credit. But what this is saying that when your supplier issues you an invoice on credit, yes, you're not going to pay them immediately, but you're going to pay them later on. But then for you realize that this credit, because you paid for VAT, this credit, you have to use it 6 months from the date of the invoice. So if the invoice is 1st January 2023, you have to utilize that credit for the input VAT that you paid before 30th June 2023. So we normally see this, of course, when you're amending returns, and that's a story for some other time. But I maybe wanted to talk about what could happen in case you do not comply for VAT purposes. So, of course, there are consequences for not complying or trying to hide outside the law in terms of VAT registration, like any other tax type, because we are in the regime that is known as the self-declaration regime. So what happens, the regime that we are under is you yourself as a business, you have to assess yourself and say, okay, these are the sales that I make, they're supported by these invoices, and therefore this is the tax that I'm going to pay. But if you do not do that, then you're becoming non-compliant. And here I'm just trying to show you what can happen in case you do not comply in some of the following ways. For example, if you're making 1 billion in revenue for every year, which is the target of HBC, I believe, Harvest Business Club, then, and you do not register for VAT, there are going to be consequences, because the URA is going to come up with something called an assessment. So remember that VAT is you take what your customers have paid you less what you have paid to your suppliers in terms of VAT. So given that you have already exceeded the threshold of 150 million and you fail to register for VAT, one of two things may happen. One, your team, which is the tax identification number, will show up or may show up in your suppliers. When your supplier is giving you that invoice, it can show up and the URA picks that up. Secondly, when the URA, because it always double checks. So it always double checks the tin, that how is this tin faring in terms of purchases this side and sales. So they always do that constant check to find out which businesses may not be compliant. So as long as you're successful, you're making lots of revenue, the URA is likely to come for you if you do not register for VAT. And of course, if you already surpass the threshold and the URA can establish that there is tax to pay, they will assess you. That's what we call an assessment. So URA will come and say, okay, from all the sales that you made, less the supplies, stock purchases that you made, this is the tax we think you should be paying. So that's, and of course, the longer that tax stays unpaid, it accrues interest. So instead of being like, say, 100 million, it may end up being 120, 130 over time. Secondly, if you're already registered for VAT and you do not file your VAT return, because you're told you, the law tells us that file the return before the 15th day of the following month. Today is February 9. So before 15th February midnight closes, you should have filed your VAT return and paid, because the filing of the return is simply telling the URA, this is how much VAT I'm going to pay. So of course, after doing that, you have to pay. But if you do not file the return, there are consequences, which is the penalty. So the penalty is a whole lot of everything mixed in that. But let's use our example. If you have VAT to pay of 1 million, then the penalty is going to be, in the law, it's prescribed either 200,000 or 2% of that 1 million that is outstanding, and whichever is higher. So the law is very, very specific. It always takes the higher side. So you see, it's very, very punitive for a company that is non-compliant. Thirdly, imagine you filed the return on time, and then you do not pay the tax, because now those are different things. So if you file the return before 15th of the following month, that is okay. Now, the next thing is to pay the tax. Now, if you decide and say, I don't have the money, I'm not going to pay this tax on time, there are going to be consequences as well. And the consequence is called interest. So on that 1 million, you have to remit to the URA. URA, the law allows it to compute 2% tax as interest on that 1 million, and it is compounded. So we all know from our math that compounded interest adds up very fast over time compared to a simple interest. So it will happen, and the longer this goes on, we're discussing on Tuesday that let's aim to be a tax collecting business rather than a tax paying business. You would rather pay the 1 million rather than adding the interest, adding things on top of that. It reduces your money, for lack of a better word, and it constrains your cash flows. Lastly, there is paying less tax. So you filed 1 million, you think you're going to pay 1 million, but then you end up paying 800,000. Still, there will be penalties or consequences for that 200,000 that you've not paid for. There's going to be still an interest if you pay less tax, because URA is always, their system is always linked to match, to check, to always cross-check. And of course, the higher the numbers, the higher the figures that are outstanding, the faster they are going to come for you, believe you me. So it's one of the things that we can try and avoid as we aspire to be healthy businesses that collect tax and not necessarily pay more and more taxes, hence being compliant. I think that's my presentation on VAT, a simple understanding for all business people on this call.
Wow.
And just to you.
Wow. Michael, thank you so much. Your presentation was very, very rich. So we have quick questions.
Yes.
Are individual artists expected to pay taxes on artworks sold?
Are individual artists expected to pay taxes on artworks sold? So again, it takes us back to what is prescribed in the law. As long as you fulfill, first and foremost, is because now the question is to ask yourself, is artwork supposed to be attracting 18%, or is it zero rated? Like taking it back to this scenario here that we had of the, sorry, I'm just taking it back here. Here, when we are starting it out. So is artwork having 0% VAT or not? Because that is what sets the law first and foremost. Secondly, it's this threshold. As long as you're making more than 150 million of sales in artwork, then you have to register for VAT. So it's now the other thing, is the artwork registered for VAT purposes or not?
Wow. Okay. Thank you so much. So how about if you pay before you file? Does it have any effect? Someone wants to pay before they file. What is your say? Does it have any effect?
So, okay, what will happen, and this is something I can speak to, is ideally, if you pay the 1 million in tax without filing, so maybe two things can happen. One is the URA is going to ask you, of course, not immediately. The URA is not going to refuse your money. They know that won't happen. They'll take your money, but then the second thing is what I'm talking about. So when you pay the 1 million, the URA is going to ask you at some time T, what is this 1 million in relation to? But the first question they're still going to ask you is, did you file your return if you're VAT registered? Because filing the return comes before paying the tax. So if you're not filing the return and you're simply paying, there's going to be some doubts or questions. But this is not, the second thing is actually the most challenging scenario, is that if, say, for example, you have zero tax to pay and you didn't file the return, but you paid the 1 million, what is going to happen is that because you did not file the return, you're going to have a penalty of about 200,000 or 2% of that 1 million, or whichever is higher. So you're going to pay that penalty. But secondly, URA is not going to give you back your 1 million immediately. No. To give you back that 1 million, they will tell you, first file the return and tell us, okay, yes, it's zero tax payable, but I want my refund. I want that money back. And what happens when you do that is an audit. I don't know if I know business people here on this call must have been through some URA audits. They're not so nice, I can tell you. So that's what happens.
Great. Thank you so much. How does one get to deregister from VAT? Because I could be thriving and the business is booming, I'm above 150, I register. Then what happens when I get below? Do I deregister? How do I go about it?
Yes. Yes, there is a form for deregistration for VAT purposes. And one thing you have to note is that even when you go below the threshold, URA will still ask you, say you go below the threshold, this is February, you go below the threshold in February sales, but January, you are above the threshold. So URA is going to ask you to first file the January return and see the sales, pay that tax, close that month. Then in this month, you file a deregistration form to deregister for VAT. And of course, they will ask you for reasons why you're doing that. That's why you can put that reason. There is a tax person can help you to do that, or you can reach out to the URA yourself to, it's a longer process, but to help you do that. But that's how you can do it. But now the challenge is going to be is that once you go above the threshold, again, you have to register. So I feel like for our businesses, it's easier to keep it in a registerable position and then keep on filing zero returns and paying zero tax, because ideally this threshold for the businesses that at least that I'm aware of that are on this call, very many people are striving to make more than 12.5 million per month in revenue.
Great. I see our time is fast spent and the questions are quite a number. So we shall ask just two more questions and then the rest will come up tomorrow. The second last one is, after registration for VAT, how do you start? Do you just add it on top of your cost price of your good or service, especially if you also have input VAT or VAT input?
Yes, that's a very, very good question. So what happens is that, of course, there are two things. On your goods that you sell to your customers, you have to add it as an extra cost to the customer. So if it's 1 million, it will become 1,180,000. But then the most peculiar thing is that what is going to happen is on the supplier side. So your suppliers have to be VAT registered. And that is like the hardest form of transition to make. Because yes, the customers, some of them can understand. But remember, if you're getting this tax to your customers, of course, some of them are going to complain. But the most peculiar thing is the supply side. How you control the supply side also is very, very critical, because you have to get people that are charging you VAT that you pay, charge your customers VAT, and then that difference is what you remit to the URA. So you also have to be getting people that are registered for VAT, because that's the only way it will be working out for you from a cash flow perspective to work out very well.
Thank you so much. Last question. There is a statement here that is a threshold is not only 150. There is also one of 37.5 million over a period of 3 months. And then there's a question of between filing and not paying and not filing, which is a better option in case there is no money. The final one, is it really possible for URA to really accept zero tax? Someone doesn't believe that you can file zero tax.
Okay, thank you. Yes, maybe I can start with, because I see them here in the chat. So is it possible for URA to really accept zero? Yes, as long as, like we said, as long as you have e-invoices, what we call e-freeze invoices. So on the purchases side and on the sales, because this is a URA system, so it can accept that because it is supported. But of course, if it is not supported, the URA is going to push back and ask you very many questions. That's one. Two, the person who asked, who highlighted about, yes, the threshold of not only 150. Like I said, this 150 is also broken down in the quarters of the year, which is the 4 quarters. So 150 million divided by 4 will give us 37.5 million in the 3 months. So same thing, as long as you look at your 3 months and you look at it and you're like, yes, I'll make sales of more than 37.5 million, then I should register for VAT. Lastly, the question about what happens, okay, that question between, I'm trying to get it here. Yeah.
Between filing, not paying and not, which is a better option, no money.
Okay. So between filing and not paying, my advice would be pay what you have by first filing. File to get that done with, the penalties and everything, and then pay what you have. But the more interesting thing actually that happens, because I know there's a gentleman that asked this question at some time, in terms of you bought from your suppliers and they're taking long to pay you, because it happens. So your supplier, you bought from them and they want cash, but your customers are taking more than 60 days or 90 days to pay you. There is something called cash basis accounting that you can apply for, but my take is you're always safer by filing first, get done that with, and then you pay what you have and tell the URA that the next amount of money will be remitted, but it will still be attracting interest, that difference that is remaining outstanding.
Oh, we really cannot thank you enough, Investor Michael. Thank you for your time. Thank you for speaking to us. I see our time is fast spent. Kindly, I see a number of questions in the chat. Let's reserve them for tomorrow at the grill. I hope that Michael will make time and come on board, because there are a number of questions that we have for you. So we look forward to having you tomorrow. I know the presenters that presented on Monday and Tuesday and today, Thursday. Without further ado, let me wish you a blessed day. I speak a blessing over us. Go out there, create businesses, close those deals, support those people and communities for the betterment of our country, Uganda, our communities, and the world at large. God cover you, protect you, guide you, in Jesus' name we pray and believe. Amen.